If you own dividend-paying stocks for income, there's something worth checking that most people don't even consider. A company can pay you a rising dividend, say all the right things about shareholder returns, tick every box you're looking for, and still be spending the bulk of its money somewhere you're not looking. That's not unusual, and it's not hidden either. Companies put out press releases about this stuff. It's just that the number rarely gets put next to the dividend, so the comparison doesn't often get made. So I want to walk you through 3 companies where it's happening, and 2 of them could well be in your portfolio. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only, and should not be considered investment advice or investment recommendations. When investing, your capital is at risk. A company's cash can only be spent once. That sounds obvious, but the language of investing is built to obscure it. For example, returning cash to shareholders, shareholder-friendly, capital return program, all of it's phrased as though these things stack up, as though a company can do more of one without doing less of something else. But in practice, surplus cash only has 4 places it can go. Back into the business, onto the debt, out to you as a dividend, or into buying back the company's own shares. 4 options, and each pound or dollar only takes one of them. Which means when a company spends heavily on buybacks, that money isn't a bonus running alongside your dividend. It's money that didn't become your dividend and didn't pay down debt and didn't get reinvested. So the question I'd ask isn't whether buybacks are good or bad, it's what that money actually bought and what it cost. 3 companies, 3 completely different approaches. One where the money bought something real, not just income. One that spent 2 years buying nothing much at all and has now borrowed billions to go all in on its own stock. And the one that did it the other way around, 20 years of borrowing and buying, then it stopped, spent the money elsewhere, and shareholders did better for it. Let's do Apple first, because Apple's is the straightforward version to demonstrate the concept. In its 2025 financial year, Apple spent just over $89 billion buying back its own stock, and about $15 billion on dividends. So for every pound it handed you as income as a shareholder, it spent nearly 6 on something else. And that's not a one-off. In May 2025, the board authorised another $100 billion of repurchases and raised the quarterly dividend from 25 cents to 26. One of those numbers is essentially a rounding error next to the other. Most people aren't going to open a 10k to find that out though, so the more useful question is whether you could have spotted it without one. And you can in about 10 seconds because someone's already done the working out. Here's the section, and look at the 2 numbers at the top of it. Dividend yield about 0.4%, and sitting right next to it, buyback yield 1.9%. Those are trailing 12-month figures, so they won't line up exactly with the financial year in the filing, but they say the same thing. Somewhere around 5 or 6 times as much of Apple's cash is going into its own stock as into your account. Underneath there's a total shareholder yield that adds the 2 together, around 2.3%. And that's the number to be careful with, because adding the 2 together implies they're the same kind of thing, and they really aren't. A company with 2.3% dividend sends you 2.3% in cash, whether the share price is up or down. Apple's 2.3% is 0.4% of that, and 1.9% of something quite different, value that only exists if the buybacks were done at a sensible price, that you can only turn into money by selling, and that management can switch off next quarter without announcing anything. So it isn't wrong to add them up, it's just that the 2.3% total shareholder yield and a 2.3% dividend are not the same offer, and only one of them pays your bills. The payout ratio says the same thing from another angle. Apple pays out a small fraction of its earnings as dividends. And here's the yield against the market, which is blunter still. It doesn't reach the bottom quarter of US dividend payers. Now the buyback did do something useful. Fewer shares exist, so your slice as a shareholder grew proportionately without you doing anything. Nothing sneaky or dishonest is going on here. But run the numbers the other way for a second. Apple spent $89 billion on buybacks and $15 billion on dividends. If they'd moved even a quarter of the buyback money across, it could have roughly doubled your income. It didn't, however. It instead decided to raise the dividend by a penny from 25 cents to 26 and put the rest into its own stock. And that's the choice, it's the same pound either way. Apple could pay a much larger dividend than it does, it's decided not to. Buybacks are tax efficient, they're flexible, and for a shareholder who doesn't need the income, they're arguably the better option. Apple has decided that shareholders are better served by owning a growing share of the company than by receiving cash, and it may well be right. It's just worth knowing that's the decision because it tells you what kind of holding this is. Apple is a dividend growth stock. It raises every year and it's been growing the payment around 6.6% a year, which is a good deal faster than plenty of companies yielding 5 times as much. What it isn't is a yield stock, and it isn't drifting towards becoming one because the growth is deliberately coming out of a small slice, while the large slice goes to buybacks. And by the way, every chart I've put on the screen came from Simply Wall Street. The buyback yield, the payout ratio, the debt history, it's all sitting on one page, per company, across 120,000 different companies. No spreadsheets, no filings, no need to work anything out, so it makes this kind of check super quick. You can go and put your holdings in. The free tier gives you 5 company reports a month, which is enough to check your biggest positions, and there's 30% off the link in the description, which also helps support the channel. A buyback can have 2 completely different jobs. It can retire shares so there are fewer owners and each slice is bigger, which is what Apple's has been doing, or it can simply mop up the shares that the company has just handed out to its staff as stock-based pay, so the count doesn't drift upwards. The first makes you better off. The second just stops you from getting worse off. Both get announced with exactly the same language, so it's not always easy to tell which is which at first glance. Which brings me to Salesforce, because Salesforce has done both within a 2-year span. Now, back in its 2024 financial year, Salesforce was unusually direct about which one it was doing. In the proxy statement, the company said its share repurchases fully offset its stock-based compensation that year. That's about as clear as these things get. Which is what the share count did. This breakdown puts stock-based compensation on its own bar, and it's roughly $3.5 billion a year against earnings of $8 billion. A buyback doing job 2 is spending real cash to cancel that bar out and achieving nothing else. That's the version worth being able to spot. The cash didn't grow your slice, it didn't speed up the dividend growth either. It didn't widen the margin of safety underneath the dividend, and it didn't reduce debt. It stopped the share count going up, and that's pretty much it. In fairness, if you're competing for engineers, paying partly in stock is normal, and cleaning up after is arguably the responsible thing to do. You can use the chart to know whether a buyback is actually shrinking the company or just cancelling out what's being handed to staff. And then look at what those same 2 numbers say now. Dividend yield 0.9%, buyback yield 23.3%. For every pound that Salesforce is currently sending you as income, something like 25 is going into its own stock. The total shareholder yield underneath reads 24%, which sounds extraordinary until you notice essentially none of it is cash that you can spend. And here's why that number has exploded. In March 2026, Salesforce launched the largest accelerated buyback in history. $25 billion in one go, part of a $50 billion authorization, retiring over 1/10 of the entire company. A chunk of that is being funded with borrowed money on notes that don't mature until 2066. Which is why the buyback yield is worth understanding properly. Here's Salesforce's, and it's enormous, far bigger than Apple's. But all that number tells you is how much is being spent, it doesn't tell you what the spending achieved. So it's really a story in 2 halves. Across the first 2 years of headlines about returning capital to shareholders, the answer to what did that money buy income-seeking investors was nothing. Their slice was the same size at the end as at the start. And now the same company is borrowing 40 years into the future to shrink itself by 1/10. If management's right that the shares are cheap, that works out well. If they're wrong, they've taken on debt to overpay for their own stock, and either way, none of it arrives as income. And then there's IBM. For most of 2 decades, IBM did exactly what I've been describing. Reuters ran the numbers on it. IBM had spent more combined on buybacks than the company has spent on capital investment in R&D over the same stretch. By 2020, IBM had spent about $140 billion buying back its own stock over 20 years. And the entire company was worth $105 billion. 2 decades of buying, and the thing being bought was worth less than the buying had cost. Back in July 2019, IBM bought Red Hat and suspended the buyback, and the filing says exactly why, to pay down the debt from the deal. The money went here instead. 5 years ago, IBM's debt to equity was about 250%. It's now 176%. 6 years of not buying back the stock, spent on the acquisition and on clearing what it cost. And shareholders did better out of that than they did out of 20 years of buybacks. Revenue at a record $67.5 billion, record free cash flow, a dividend that kept rising throughout, while the share count actually drifted up because nothing was buying it back. So $140 billion went into the stock and left the company worth less than it had spent. Then the buying stopped and the money went into the business, and the holders did well while being mildly diluted the whole way. And that's the general case against buybacks as a strategy, and IBM saw both sides of the policy. So, 3 companies, 3 separate answers to the same question. What did that money actually buy? Apple bought a smaller share count, real value but delivered later rather than now, and not as income. Salesforce spent 2 years buying nothing but cover for its own staff pay, and is now borrowing to buy back 1/10 of itself. IBM bought 20 years of nothing and then stopped, and its shareholders did better afterwards than before. 3 companies all describing it the same way, returning cash to shareholders. 3 completely different outcomes for the person holding the stock. A dividend does one predictable thing. A buyback might make your slice bigger, might just stop it shrinking, might be borrowed, might be money that would have served you better as income. and the announcement alone will not tell you which of them it is. Which means you have to check, holding by holding. And if you're like most dividend investors, your portfolio probably lives in a spreadsheet. The holdings, the payments that have come in, maybe a yield column, which is fine as far as it goes. But notice that everything in it is about the past, income that's already arrived. What nothing in that spreadsheet can tell you is what's been happening to those dividends right now. The buyback taking 6 times what you're being paid, the payout ratio creeping up, the debt building underneath the payment. All of that lives in the filings, and the spreadsheet has no real way to find that info out. So checking means going company by company, filing by filing, and then again next quarter because these numbers move. Salesforce's buyback yield went from single digits to 23% inside the space of a year. But that's the upgrade that Simply Wall Street's portfolio tool gives you, less a tracker, more a command center for your portfolio. You put your holdings in once, and every check from this video sits there for every company you own. Dividend yield next to buyback yield, payout ratios, the debt picture, all kept up to date without you doing anything. If you follow my almost daily dividend series, you'll have seen it in action already, because that's what I use to run the whole ADD portfolio. For a dividend investor, it's a seriously useful tool. The link in the description takes you straight to that portfolio so you can see the full overview for yourself before you build your own around your holdings. It's free to try and you don't even need to put in a card to do it. Click the link, add your holdings, and you'll have the same overview I've been showing you today on your own companies in a couple of minutes. Then, if after 14 days you decide you want the full experience, that same link gets you 30% off any of the subscriptions. And using it supports the channel, so thank you if you do. Either way, run this check on what you own, because as we've seen today, returning cash to shareholders can mean very different things, and only one of them pays your bills. Hey, thank you for watching. If you made it this far, YouTube thinks that you'll like this one next. And if you want my free Dividend Commandments PDF, it's the checklist I use to spot red flags before I buy stocks. Link is here and in the description.